investors to consider straightforward strategies to reduce their overall portfolio risk. Covered call strategies and our new fund are attractive, and our new fund is an attractive opportunity to reduce overall portfolio volatility while also retaining that exposure to the S&P 500. And so the second and potentially more important component for the fund, and why today, why now, why this fund, would be that investors are always searching for income. And the new strategy targets a 6 to 8% annual dividend yield. We generate that through the sale of covered calls. And that's an exciting opportunity. Anytime that you can generate that level of income through an equity strategy, I think that gets a lot of people's attention. I think that may get a lot of attention from fixed income investors who may not be comfortable going as far out on the credit curve or the duration curve needed to find that level of income.
That is fascinating that you brought up duration and sort of the fixed income market there. Okay, we'll probably circle back to that and to covered calls. Andrei, tell us a little bit about the equity strategy itself. What can you share with us on this?
Yeah, so under the hood, we have a large cap equity strategy that's investing in equities with market capitalization similar to what you'd find in the S&P 500 or the Russell 1000. So there's a quantitative approach under the hood that's run out of our QRI team that works hand in glove with Eric on the derivatives side. And so they're taking traditional inputs that you'd think about, your quality, your growth, your profitability, those types of inputs. They're also taking some non-traditional inputs in their security selection here. So what they're doing under the hood is they're taking a look at the S&P 500, they're taking a look at the Russell 1000, and that's kind of the sandbox that they're playing in. And they are making some slight tilts around, sector allocations as well as security selection. So ultimately, what they're trying to accomplish under the hood here is, have a risk that's similar to the S&P 500, but still trying to derive some alpha. Because ultimately here, we are taking the approach of a total return perspective, whether it's what Eric's doing on the option side or what the equity portfolio managers are doing on the equity side as well. So we're very much taking a total return approach and trying to squeeze out as much as we can on both sides of the ledger there.
So interesting, and the construction and sort of the engineering behind it is fascinating. Eric, tell us a little bit about how this competes with. There are other products in the market that would try to accomplish something similar. What would you say differentiates this particular fund?
Yeah, sure. Great question. This is a popular space. We have an awful lot of competitors in the options-based strategy space. Covered call strategies are incredibly popular, and I think that's because they've been in existence for over 4 decades. We have very transparent third-party benchmarks, so investors have a long track record of being comfortable with them. And so, when we think about the space today and how we stack up relative to competitors, we're thinking about a couple different things. How can we provide a product that produces an attractive level of yield, but also seeks to efficiently balance equity upside opportunity? And I think most investors in the covered call space, the high income options-based space, are aware of one important thing. The higher our annual income is that we produce through the sale of calls, the less equity market upside we will retain in the fund. And so we believe that the right balance is around 6 to 8% in an annual dividend that's going to be paid monthly. And that's going to allow us to champion or cheer for the markets to go higher. So again, this is at our core, this is an equity fund. We want to see the market continue to rally, and to rally at this clip. That would be fantastic. We think that that's frankly an alpha opportunity for us relative to our peers in this space. So we're seeking to hit that optimal balance between attractive level of income and also long-term equity appreciation.
Fantastic. The risk profile, the who this is for, and their own risk profile. Andrei, take us there. Who would this be all right for? Who might this really advantage?
Yeah, so it's a great question. So, if we take a look at this particular mandate, and we just take a step back, we think about the Canadian marketplace.
Sure.
As most folks, know, we do like our income here in Canada.
Canadians love dividends.
Take a look at dividend funds. We know where the flows go.
That's right.
So it is popular, but I think what this product brings to the table is when we think, if you're taking a look at your portfolio and you're looking for income solutions, historically it's been, fixed income, cash alternative products. or even dividend strategies, as we just mentioned here. I think this is kind of a new innovation in that particular bucket, in being able to provide a different source of income with a different return profile than perhaps we've traditionally seen in some of those other income products. So obviously, as Eric mentioned, one of the key kind of focuses here is that cash flow opportunity that you're able to get on a monthly basis. But where it might differentiate from, say fixed income, for example, is you do still get that capital appreciation opportunity as well. And then all of that under the hood, the particular strategy and the way it's put together, it does typically able to give you a lower volatility product relative to just a long only equity strategy, for example, like an S&P 500. So again, you're getting that cash flow, you're getting that reduced volatility profile relative to the S&P 500, and you're also still getting that capital appreciation opportunity. So, this could work for a myriad of different investors. Here in Canada, we do have an aging population, so the income needs of Canadians is going up as well. So, for someone who is thinking about retirement, who maybe needs to look at a little bit less risk, but still wants some capital appreciation while also getting that monthly cash flow, this would be a great product for a client like that.
So interesting. Eric, take us to two parts of the construction. Take us through a covered call, the role that plays in this fund. Let's just go back to that basic.
Yeah, sure. Yeah, so great question. Covered calls are the heart of our income generation engine in the strategy. So it's important to note that covered calls can be deployed on both single stocks, on ETFs, and on equity indices, and they can be traded in an exchange-traded manner or in an over-the-counter manner. I think it's important to note that everything we do here at Fidelity is in a risk-managed framework. We don't speculate. We like to reduce risk with every options-based strategy we deploy. In that spirit, this strategy deploys S&P 500 listed call options, and we do so because we love the liquidity. We're talking over $1 trillion of average daily volume in notional terms. We love the transparency. These are options-based securities that sometimes can be a little bit confusing for investors. These are securities that you can look up on any Google search or Yahoo search. You can always get a price. So there's very transparent there. And we like them because they offer us tremendous operational efficiencies relative to a single stock implementation. So that's a little bit about, maybe the details of the option strategy. But what I think I would like the listeners or the viewers of this show to think about is we're doing something unique relative to our peers in the options design. And that is that many of our peers will trade or sell a call option against the equity notional value, typically once a month. And that once a month rebalancing of the call option certainly generates premium, and it's going to reset the option characteristics in the portfolio. However, I think we all realize that the equity markets are moving at an ever faster cadence. And we think that it's our job to create a product that is going to stay in sync with the markets, if you will, in closer touch with the current market dynamics. And so to achieve that, we roll our options on a weekly basis. And so at all times, we hold 4 option positions at least, and we hold 4 options that are a different strike price and a different expiry date. So it's a laddered strategy where we're rolling approximately 25% of our option portfolio every single week. This helps us stay in tune with the market, but more importantly, Pamela, it helps our investors have greater, I'll call it symmetry, or a smoother ride, if you will, instead of the clunkiness or the lumpiness of just an options portfolio that's balanced once a month.
That is so fascinating. Andrei, I put the next one to you. Maybe you both follow up on this, but just sort of take us through, maybe it's obvious, but for instance, that massive dip in August, which lots of people lost lots of money, and then we've seen many buy the dip rallies right back into it all. We're sitting at all-time highs. Again, in this context, markets moving faster than ever, as you just mentioned, what is this giving investors that you wouldn't get otherwise?
Yeah, and I think Eric brings up a good point about that weekly rollover. So in a scenario, in August when we did get a volatility spike, markets went down. The fact that we're rolling it on a weekly basis. So typically these volatility spikes can be rather ephemeral. Last a few days to a week long. By rolling some of those positions on a weekly basis, we're able to capture more of that premium. So for example, just to take a step back, so a big determinant for option prices and the premiums we collect is volatility levels. So generally speaking, higher the volatility levels, the higher an option premium. So the more that we collect when we're selling those options. So in this case, relative to say a strategy who maybe writes options on a 1 month basis or even a quarterly basis, this type of strategy would be able to take advantage of those increases in volatility and ideally drive a little bit more income in those scenarios for our investors as well.
Interesting. Is the timing of when someone gets into this fund, Eric, relevant to our conversation here today?
Well, it's relevant from the perspective that we seek to eliminate the timing risk. So again, if you think about a strategy that's only rolled once a month, the option positions can be, several weeks old. There is a timing risk for between one individual entering on day one of the month versus the individual that comes in 3 weeks later. That option position will be materially out of date. We seek to rectify that. So the timing is a positive. Pamela, on your previous question, going back to August, one of the beauties about selling call options, we derive premiums from volatility. So, what we saw in our US-based version of this product is that we noticed that premiums actually doubled in that period. So, volatility's, a welcome thing. And, I think that it's nice to note that our option premiums tend to increase and, they can double or even triple right when the investor wants it to happen most. And that's periods of, intense volatility spikes in the market. That's where we really want to see the premiums coming into the product, which obviously gives the investors, I think, a higher level of income potentially, and also does a better job of reducing volatility for that short period.
Yeah, that's fine. Is there anything else you want to just sort of put out there on the risk profile? Because it seems like a good moment to be digging there.
Yeah, I think Eric made a really good point, and I'd just like to talk about that a little bit. And I think what Eric's trying to say is, you're getting that offset in times when you really need it.
Yeah.
When equity markets are going down and vol's going up, ideally your monthly cash flow is increasing. So you're getting that protection when you most need it to help dampen that downside risk. So I think that is a really good feature of this particular product.
Yeah, fascinating. Just take us back, Eric, to the fact that this is largely based on the S&P or S&P 500 like securities. What are people investing in? They're investing broadly in sort of the U.S. equity markets. That's right?
Yeah, that's correct. Yeah, so the universe of the equity portfolio is the Russell 1000. Typically, the portfolio is going to hold between 100 and roughly 200 names. And I think it's an interesting approach. As Andrei outlined, there are some unique aspects to the quantitative design of the product. We believe that there's alpha in this product relative to the S&P 500. And so that makes a lot of sense for someone like me. When you think about, well, why didn't we use just a passive IVV or SPY? Well, there'll never be any potential for alpha in that type of allocation. And so what excites me is that we're selling call options against the S&P 500, that passive beta. In the strongest of markets, let's say the S&P 500 rallies 10% a month. It's not out of the realm of possibility these days. We know that our short call options are going to truncate our upside participation in that rally at some point. But here's what I love about our equity portfolio. We may have 50, 100 bips of alpha in that month in our equity allocation. And so because we're selling calls against the passive beta, we're able to capture the alpha that exists in our equity portfolio. So that alpha beta separation, I think, is an important attribute. And Pamela, this conversation reminds me of an interesting and I think important attribute of the strategy that I've thus failed to mention. So we target call options. Every time we sell a call option each week, we're going to sell a call option that is 2 to 4% out of the money. So that's,
explain that for us. Explain that for us.
Yeah, sure. So basically, we're going to sell a call option each week we're going to seek to capture premiums, right? So we know there are buyers in the market that seek to speculate to the upside, and they're going to pay a premium to reserve their right to buy a call option that says, I can buy the S&P 500 market at this price on this date. They pay a premium for that. We as sellers benefit. We capture that premium. And so there's a trade-off, right? We know that we're going to take the premium, but we now have the liability of having to deliver our equities if the market were to appreciate. Well, how do we minimize that liability or that risk, that upside truncation risk? we sell calls that are further out of the money, that capture more equity opportunity. And so it's important to note that many of our peers will sell at the money call options. So minimal, if any, upside opportunity for their equity allocation for a month or maybe longer. We're always going to target 2 to 4% out of the moneyness. That means that the market could rally 4% in a month, and it's all good with us. We get to capture all of that equity appreciation, and our calls are going to settle at the money, and we're going to get to keep all of our option premium.
This is the differentiation. I mean, this is the differentiation between other products that are going to do similar things, but competitors are doing.
Yeah, absolutely. I think what's important here is it's very easy with these call options. As Eric mentioned, there's some that are selling right at the money, and at the money options will get you a higher premium. But then you are massively increasing your upside truncation risk there. So I think
truncation. We call it a melt up.
Exactly.
Okay.
So markets go up, and now you're losing on your options. So I think what's great, and what I think Eric does fantastically with the equity folks is particularly on the derivative side, is again we are taking a total return approach. We're trying to think about how can we capture as much of that upside? How can we get as much premium as you can without sacrificing too much of that upside?
Right. Okay. Fascinating. I wanted to go into the tax advantage story. Eric, that's not for you. I'm just going to ask Andrei to stick with it for 1 second. There are some tax advantages to looking at this strategy. What are they?
Yeah, so if we think about the call option premiums that we receive, those are typically taxed as capital gains.
Right.
So again, if we think about an income distribution perspective, and we contrast that to say a GIC, which is 100% income, there could be potentially some after-tax benefits, so some after-tax yield benefits from this particular strategy. So just another angle to consider when we're thinking about, the pool of investable assets in the income space. There's a potential advantage here from a tax perspective, and at the end of the day, it can make a big difference to your after-tax yield basis.
Absolutely, absolutely. So I'm just going through some great questions that are rolling in here, Eric. If you could tackle this one, do you have a targeted expected total return for this particular product? How do you sort of look into the future and set your goals?
Yeah, that's a tough one to answer.
That is a tough one. Sorry about that. Yeah, not from me.
No. It's a great question. It's one that I wish I had the answer to. I think the most elegant answer to that is so we have a benchmark, the BXY index, that's in the US, and it's a 2% monthly buy right strategy on the S&P 500 index. That is the benchmark for the strategy, and we have historical data going back to 1986, daily data on that strategy. And I think that's where I certainly, going back 15 or 20 years, that's where I set my expectations for how this strategy will perform. But and I would put that as a good reference point. But this is a strategy. Listen, I am in my heart an equity investor. I want to see the market continue to go up and annualize 26% a year for the. I have 2 young kids and a mortgage. Like, this is all good. I want to capture
Let's
as much
go,
as
26%.
Yeah.
Yeah.
So,
yeah.
But this product will capture the majority of equity market returns over a market cycle. We know that we have a high degree of confidence, and we have the history to back it up, that we can consistently generate this level of yield. And I'd say the third point is we know that over a market cycle, we're going to dampen overall portfolio volatility by 15 to 20%. So if any of those 3 attributes appeal to the investor, I think it's going to be an attractive allocation.
Okay, fantastic. This one's for you, Andrei. Is the entire premium going to be paid back into the fund?
Yeah, so I guess the question is, I think
that
is
premium you've been talking
that
about.
we're getting.
Yeah.
Are we planning on distributing it out to investors? So again, this is going to be a monthly distribution product. So the dividends and the premiums that we gather on a monthly basis, we're looking to distribute out to investors.
Okay, perfect. Is this product available as a mutual fund or IROC only? It's an ETF. So just tell us a little bit about how it's available.
Yeah, so right now it is only an ETF. The lion's share of kind of the covered call space in Canada has been primarily focused in the ETF space. So for us, we were looking to again focus on the ETF lineup here with this particular launch. So short answer is ETF only for now.
Okay, ETF only for now. Eric, let's go to you for this one. Does liquidity matter for this product? Do you need to spread out calls at multiple strike prices? I think you mentioned you do. Do you want to just go back there, touch back on that?
Yeah, sure. That's a great question. It gets at the heart of why we trade S&P 500 index options. So yeah, going back to the comment that we're risk managers, right? What's one of the most important attributes of any risk management tool in times of crisis? And it comes down to liquidity in my book. And so that drives us towards the S&P 500 index options. I don't know of a more liquid security out there. So that's why we've incorporated them in a listed format in this fund. We do prefer to trade them in at least we break up the trades. We do that more for shareholder experience than we do to hide our market footprint or to ensure that we have the liquidity we need. Frankly, as a long-term S&P 500 index option trader, it wouldn't be hard for us to trade $2 to $5 billion within a day. So we have all the liquidity we need. We do break up the trade for, I think, other reasons. It does certainly help to camouflage our market footprint if the fund were to grow to, $15 or $20 billion. Let's hope that happens. But generally speaking, I agree. Liquidity is critical to us, and it's why we picked the option securities that we did.
This is the bigs. That's a lot. That's fascinating. Andrei, back to you on this particular question of sort of where it fits, where it belongs. I mean, you almost described, I thought, something that you could discuss as in there in the 60-40. It's giving you a little bit of everything. It's obviously an equity strategy. But that said, Eric started us off saying that, it might be something that those interested in fixed income and sort of the duration part of that story could also use. So kind of bring it back into whether it's core, I guess.
Yeah, I mean, it certainly could be a core allocation to any portfolio. If we think about kind of the return characteristics, it certainly sits closer to the equity side of the ledger, but you do get that income stream that sits a little bit closer to the fixed income side of the ledger. If you take a look at kind of the volatility profile, and I'm thinking about the the benchmark that Eric referenced, so that volatility is certainly sitting a little bit higher than fixed income traditionally would, but it is certainly sitting lower than kind of your traditional S&P 500. So I don't want to say it's a hybrid, because it's obviously an equity strategy, but it does take on some characteristics of some of those fixed income distribution characteristics, I would say, with also getting kind of the capital appreciation opportunity on the equity side of the ledger there. So in terms of the 60-40, and again, it really depends on kind of your allocation, what you're trying to do under the hood, right? From a risk perspective, it's tough to take away from the fixed income, but certainly people have a little bit of flexibility around the edges. So we'll sit somewhere in the middle of that 60-40, where you are getting those income aspects and a little bit of lower volatility, but you are still getting a little bit some equity characteristics as well.
Eric, can you speak a little bit to what you're doing in the markets with this fund each day? Because you mentioned sort of the weekly piece of it, but what are you in there looking at on a daily basis? And maybe just speak to that, like how you need to react one way or the other.
Yeah, of course. Yeah, no, I appreciate that. So, so it's important to note that this new fund is going to complement a collection of funds that we now have on the option space platform. So my day-to-day focus is solely focused on the management of these strategies. So, and the care and feeding of these strategies, if you will, particularly in an ETF format where we can get daily inflows, is of course, the day starts with what's happening in the world, what's happening with the underlying securities, what's happening with our market, right? So I think that's job number one. Let's get a feel for what's going on in the world and how it's going to affect our portfolios. In a framework where we can have investors come and go throughout the day, of course, it's really important to monitor those inflows. And how do we absorb them into the portfolio? Do we have to adjust the quantity of options we have deployed? and what's the most efficient way to do that. And something that I'm very proud of, and this gets into the weeds of the interoperability or the connectivity within our group, but we work very closely with the equity team on a daily basis, intraday communication at all times to talk about inflows or outflows and what is the most efficient way to reflect those in both the equity portfolio and the option portfolio. Because let's face it, we want to get rid of any latency. We're not in a world anymore where, geez, we can reduce the size of the option portfolio and then 2 or 3 days later the equity team makes their update. We want to harmonize those so everything's happening in real time and in a choreographed way.
Fantastic. Let's leave off just with a note, Andrei, on sort of why now, why this belongs perhaps in clients' portfolios at this point. It's being launched here in September after a pretty wild ride over the last few years. Why is this important now?
Yeah, so as I briefly touched on earlier, there has been increased demand in income-producing products. The Canadian market does love their income products. We've been working on this project for quite some time, closely with Eric and many folks internally. Again, we want to provide a product that's an extension to those income-type products that we're currently seeing in the market, something new and innovative and fresh. That again, I've mentioned, investors do have a large demand for these types of products, and I think we've done a really good job to bring a good competitive product to market that I think is going to fill that need for those types of clients, and we've done it in a new and an innovative way.
Fantastic. Eric Granat and Andrei Bruno, delighted to have you join us here and speak and explain how this fund works and ultimately who it might work for. Have a great rest of your day.
Thanks, Pamela.
Coming
thanks,
up,
Andrei.
yeah.